Greetings. In this video, we're going to be looking at perspectives on what interest is and what function it serves in modern capitalist economies. So what is interest exactly? We can look at this in a couple of different ways. You can think of interest as the rate of growth on the assets you hold through time. So how much money you'll make on your financial investments through time. But you could also look at this on the debt side of it, so your liabilities, as interest is how fast the money you owe will expand over time. And before we move on to the theoretical components of this, it's worth pausing and learning about what we call the rule of 72, or sometimes you'll see this written as the rule of 70. It doesn't really matter which you choose. This works like this. Suppose you've made a financial investment with a 3% annual rate of return, a 3% interest rates that you'll earn with that assets. You can take the number 72 and divide it by that annual rate of return to find out approximately how long it will take for your money to double. So in this case, we just take the number 72, divide it by 3, that percentage rate of return, to find out that it'll take about 24 years or so for that money to double. But again, we can look at this on the debt side as well. Suppose that you take out a student loan at a 4.5% interest rate. Then, assuming you don't make any payments for the sake of arguments, that debt will double in about 16 years. And we find that by taking 72 and dividing by 4.5 to get 16 years for that debt of yours to double. So, moving on, what does interest do? And there are many ways of looking at the role that interest plays in modern capitalism. From the neoclassical perspective, and you've seen this in previous videos, interest is a reward to savers, but it's a cost to borrowers, and interest plays the particular function of balancing the two out so that savings and borrowing, specifically borrowing for the purposes of investments, is equal. From other perspectives, heterodox economists, some classical political economists, and so forth, interest is an unearned income to what we call the rentier class. So let's look at each of these in a little bit more detail. From the neoclassical side, interest is the price in what we call the loanable funds markets. We're using the standard supply and demand model here to understand finance in a general sense. In this market, supply represents people saving their money and making it available, that is, making it available as loanable funds on the markets. The higher the interest rates, the greater the reward for saving, and therefore the greater the supply of these loanable funds. On the demand side, then, we're looking at borrowers. You can think of these as businesses, say a food truck business who needs to borrow money to buy maybe a grill or something. These borrowers are borrowing these loanable funds, and of course, the higher the interest rates, the higher the cost of borrowing, and therefore the lower the quantity demanded of these loanable funds. The interest rate then is the price in this market balancing out supply and demand, so that in the aggregates, in the whole macroeconomy itself, what interest is doing is it's balancing society's desire to consume today, which is to say not save, against society's desire to produce more in the future, which is to say to invest. On the heterodox economics side, though, interest is simply a form of income to that group of people that we call the rentier class. From this class-based analysis, what we're looking at is a group of people who make their money by virtue of ownership rather than directly engaging in production. So interest is a lot like rents, which, along with capital gains and dividends, are the incomes that stem not from producing things, but rather from making financial investments, from owning things like bonds or real estate or stocks or what have you. And these incomes allow this rentier class to buy and to consume what society produces without, again, having actually contributed to the production of that stuff outright. A couple of other perspectives are worth looking at as well here, though. From the perspective of an individual bank, interest does a couple of things. First, it covers the risk of borrowers from the bank not repaying those loans, of defaulting on those loans. So, for instance, if the bank makes a number of loans to a number of different businesses, some of those businesses may not be able to make enough money to repay the loan. The interest the bank charges on the remainder of the loans, then, will cover that cost of defaults. Interest also, of course, provides revenues to banks. And lastly, from the perspective of John Maynard Keynes himself, interest is going to play an important role, having an important connection to a special property of money, namely liquidity. Specifically, as we'll see down the line, interest is going to be the reward for parting with liquidity. But we'll come to that when we do.